Welcome to Bitcoin's post-halving shakeout. If you're asking yourself why price isn't moving up after the halving, we're going to talk about what you need to know before you make another trade. Hey guys, it's Keith Allen, and sorry I'm a little late today. I've been a super busy morning, but nonetheless, we're going to dive in and see if we can figure out why we are in this mode of price action for Bitcoin. But first, of course, a little bit of housekeeping. I'm not a financial advisor. I don't provide financial advice of any kind or any way, shape, or form. Nothing I say or share should be considered trading advice at all. All right. So, with that, let's just go ahead and dive in and look at the history of halvings. Okay. We had the halving here, obviously, on Saturday, and I think a lot of people expected prices just go up from there. And, um, the macro analysis kind of says that fundamentally, the halving creates a reduction in daily supply, and that should demand be what it has been, should help price appreciate. Now, we of course had a tremendous amount of demand from ETFs coming that started early in, or actually late in December, moving into the January decision to start selling ETFs on January 11th. We had a bit of a sell off, and then it was off to the races here, right? So we all know how that has transpired here, and then we've been in nearly an up only mode with just a little bit of consolidation here in the 50 to 52K range, and then none of these levels have been previously retested. So why isn't price just shooting up from here? Well, we've talked about this extensively in the past, and today we're going to dive into it again here, right? So these blue lines represent prior halvings. We just had our fourth one, okay? And if we go back even as early as the first halving back in 2012, you can see that after the halving, there was a brief a weekly up, and then a period of downward consolidation. Okay, this wasn't a huge move down, but nonetheless, it price consolidated for weeks and weeks and weeks. Okay, so if this was the high, this was roughly a 10%, just shy of a 10% move to the downside before and consolidation here before things really took off. And obviously, that was just a monumental move. Now, I don't expect to see moves to the upside nearly as big as this, because of course a lot has changed, right? So that was almost a 2000% move. So I'm not expecting a 2000% move, but I am expecting a solid move to the upside over the course of the next several months, or possibly even a year or more. And so let's move now to the second halving back in 2016, and look at this. Very similar to what we're seeing now, we saw a pullback. Now this one was much bigger, had a big wick down, but nonetheless, the point is we do have periods of consolidation and often corrections before things really start to take off. And so in this instance, it was, the local high was pre-halving. This was the pre-halving hype here, and that local high. Obviously, we had a big correction from there. That was 40%. And we've talked about the potential for 20, 30, 40% corrections throughout this cycle that have yet to materialize. Even if we took it to what that top was after the halving, that's still a 30% correction, right? And that is a reasonable expectation to happen, especially considering the fact that we haven't seen one of that size. And even through the bull run, there have been corrections, right? So even in this bull run up to the 2017 top, where we hit almost 20K, there were corrections along the way to the tune of 30%, 40%, right? So this one was 35%. This one here was even more. Okay. So again, don't rule out the possibility. That's not to spook you. That's not to scare you. It is to educate you. All right. And hopefully, you're ready to take advantage of those opportunities. What you really have to be cautious of is over leveraging yourself to where you get destroyed and just get absolutely annihilated in one of these corrections. It's not a matter of if it's going to happen. It's a matter of when it's going to happen. So now let's look to the 2020 halving, which really kind of looks similar to what we're seeing right now. Again, there was a nice rally up. This was, of course, the COVID crash that took us way down, and then a rally towards the halving. Man, I wish I had saved everything I bought down here. Those were different times, right? We had no idea how COVID was going to develop, right, and how the economy was going to recover from COVID. But that's history, and so is this. And what we can gather from this history is after the halving, there were indeed corrections. This was a weekly candle. This was a 10% negative, a negative 10% weekly candle right after the halving. So again, it's reasonable to expect that to happen. And before things really took off, we saw a period of consolidation with a brief correction. Okay, so a spike to up to about 10K, and then a correction of about 15K, and then things took off. And even after things took off, there was indeed another correction, and that one took it down to the trend line, 20%. So the moral of the story here is be prepared for these corrections to happen. They're part of the normal cycle. And so in this instance, here we are. We had this rally towards the halving. We saw a new all-time high. And, this was maybe the overhype, right? This was due to a lot of the ETF demand, perhaps, that helped us get up to this level. We did create a new all-time high before the halving. I don't think that's something that typically happens. In fact, let's just go look at that. Let's not speculate. Let's go look at that. Okay, so this, back in the early days, this was indeed an all-time high, but that was way before the halving, right? This was months before the halving, and then obviously everything from here is creating new all-time highs along the way. Correction, boom, boom, boom. So into the market. So at this point, this is not an all-time high. This is a recovery from the prior bull market. The market bottoms out. We see things moving, and new all-time high post halving. Okay, and then after the halving, another new all-time high. And look how long it took to get to this all-time high. The halving was in May, and it was December until we made new highs. So, or new all-time highs, I should say. So that took months and months and months to develop. And so here we are now, 2021 top. Obviously, we had a bear market that followed, and here's the rally out. So we did create this new all-time high before the halving, which is not typical. And now what is happening, this pullback, is kind of typical if we look at the history that I just shared with you. So in terms of where we could go from here, it's reasonable to expect a continued consolidation in this range until we see some major changes in liquidity or something fundamental changes, whether it's economically, whether it's geopolitically, or there's something else hovering out there that we don't know, an unforeseen black swan, whatever the case may be. Downside targets remain. This, to me, is the most important one. Our local low at 59K. Depending on the exchange you're at, this one was 59.3 on Bitstamp. I think it's around 59.250 on Coinbase, and that's going to vary from exchange to exchange. But we did challenge this a couple of times, right? We had a retest here. This one wasn't quite a retest, but this one sure was. And this one came down to 59,629. So far, this is where we're trying to validate an RS flip. RS flip, for those who don't know, is a resistance support flip. We've yet to do that here at this 2021 top at 69K. And let me move into the daily chart to illustrate that a little bit more clearly, right? We challenged it, got rejected. Came back, challenged it, got rejected. Finally broke through it, but wicked down day after day. We had one solid candle here, and the market got excited. We topped with a new all-time high and got rejected. Another attempt, rejected. Another attempt, wick down and retested, was looking good until the next day when that wick came through. That invalidated the breakout for me. And again, we saw this weakness, right? So it's hard to consider it weakness when you see. I can understand how you might think it's hard to consider weakness when you see price breaking out above, but I'm looking at what's happening to the downside, and all these wicks below to me were signs of weakness. Also, the fact, notice this, notice declining volume here, right? So this was a perfect recipe to see things break down, and it did. As we move through April, again, we got another attempt rejected, another attempt rejected, rejected. Finally broke above. We get a candle above. We get another wick down. There's the weakness. Here's another wick down, more weakness. One solid candle above until the breakdown. Okay. And of course, recent geopolitical events in the Middle East may have been a catalyst for this. Nonetheless, even without that, as I've shown you in the chart and all this history, this move to the downside is typical of post halvings. Okay. So don't be alarmed by it. Protect yourself. Don't over leverage yourself, and prepare yourself for opportunities should they present themselves. Again, the fact that we haven't had a correction here or a retest down to this level is interesting to me. Same with this level. We don't currently have a lot of sentiment to go there, and I will show you what the liquidity looks like in the order book here in just a minute. But in terms of targets to the downside, this would be a from the all-time high, from the new all-time high, which sits at 73,750, 738, what is it? 73,794. So we'll call it, 73,800, something like that, right? I don't have to be perfect for this. A 20% correction would take us down to this 59K level. A 30% correction would take us down to this 50K level, 50 to 52K range. And a 40% correction would take us down to this 44, 45K range. And this has been an important target for me because we spent so much time consolidating here. Now, these consolidation ranges, they serve as strong foundations for the next move up, or potentially the next move down if there's a breakdown, right? And so they will be the strong resistance going up and the strong support coming down should price revisit those targets, right? So if we do break down further and this doesn't hold, then I would think that this is a likely hold. Of course, we have to see how things develop. What transpired to send price down that way? What transpired to send price down this far? And with the Hong Kong ETFs being approved recently, those are going to start on April 30th. It's hard to expect price to move down in this direction this far. Anyways, speaking of ETFs, let's just take a quick look over there. And we can see that yesterday was the first day in 71 days that BlackRock did not buy. So they had a 71-day streak of buying daily and did not buy yesterday. So they don't set a record. They did make it into the top 10, but some interesting data on that. I'm going to head over to the Black Knox feed on Twitter, and we can see Eric Backelness from Bloomberg. This guy's just really been on top of the whole ETF scene. So I encourage the follow if you're not following him. If you're interested in what's happening with these spot ETFs, he's the guy to watch, in my opinion. In any case, the net assets. So they topped out at 71 days or 72 days or so, which put them in the top 10 of largest, or most consecutive days of buying for any ETF. But in terms of the size of the asset, they have set a brand new record, and Fidelity is right behind them, right, in terms of net assets after the first 72 days. So this is very impressive. Even ARCB is up there. This is very, very impressive to me in terms of what the Bitcoin spot ETFs are doing performance-wise. And when we have Hong Kong coming in here with a whole new batch of pent-up demand, I do expect to see some buying. I'm not sure that it's going to be as robust as the U.S. counterpart was out of the gates, because they have the advantage of seeing what, how things have transpired here. Now, that said, I think moving over here, we can see that uh, just based on the ETF flow, that the ETFs are no longer just buying, buying, and buying and buying as much as they can. They're now trading the market alongside the market, and so I think it's more important for BlackRock and any of these other entities not to be concerned about setting records or breaking records, but to be concerned about what are the best buying opportunities and selling opportunities for the investment class. And if it's pegged to Bitcoin spot price, then it makes sense to not be buying on days that you think price is going to go down further. And so that's exactly what we're seeing here at this point. It doesn't spook me at all. I've read articles and people saying, "Oh, now that BlackRock's not buying every day, we're going to have a problem." It's not. It's a non-issue, right? The market is doing what the market always does. Looks like we got a couple of. Oh wow, man! Have I really not been sharing the screen this whole time? That sucks, guys. I'm really, really sorry. So let me. I'm sorry, man. I told you I'm behind the eight ball today. So let me dive back into this. Holy shit, that sucks, guys. I apologize. Um, wow, that sucks. So let's do this, guys. Here we go. Yes, I am trying my best. Thank you, Chase. Thanks for recognizing. Um, let's do that again, man. Oh my god. Oh man, that sucks. All right, guys. Reset. So here's the ETF flows for yesterday, and this is what I was talking about. BlackRock did not buy, and don't worry, we'll go back to the halving screens and the candle chart and look at all that stuff, and I will explain it to you again because I severely fucked this up. That's all right. Um, so this is what I was just referring to in terms of the net assets after the first 72 days. You can see that BlackRock has just absolutely smoked the field in terms of all other ETFs in history, in terms of how much they have accumulated net assets in the first 72 days of their existence. Fidelity's Bitcoin spot ETF is right behind them. ARCB not too far behind. That is impressive to me. But what I was saying is, it's not a problem for me that they didn't buy yesterday, and that they shouldn't be concerned about setting records. They should be more concerned about what's the smart time to buy and what's the smart time to sell. And they're playing the market. So now let's backtrack up to the candle chart that I did such a fantastic job of explaining to you guys, but not showing you guys. So let's go back in history here. I'm going to take it to the weekly chart because that way we can get more on the chart and look at what has happened around the prior halvings. Okay. And here you can see the first halving back in 2012. We had an up candle afterwards, a period of consolidation for 1, 2, 3, 4, 5, 5 weeks, 6 weeks or so before price really started to move up. This was just a massive, almost 2,000% move here. Nonetheless, I don't think that's indicative of what we're going to see in terms of upside. I do think we're going to see some upside over the next several months, maybe even a year or more, but not right away, right? Consolidation periods happen. They're always, in my opinion, they're strong foundations for the next leg up. And as we look to the next halving, this was, by the way, I think this was about a 10% move to the downside. Let's just look at it really quick. Boom, boom. It's about just shy of 10%, right? So not earth shattering, not anything to panic over. Here we go. 2016, same set of circumstances. We saw price spike. This is like in anticipation of the rally. The market gets very excited. They're like, oh, stuff's going to go up, and they pump, they buy, and then of course there was a dump before the halving. This happened a few weeks before the halving, and things started to break down. And from there, that breakdown, how far did it go? I'm not even. I could use this local high here and say that was a 40% breakdown, or we could be more conservative and say post halving, it was a 30% breakdown or so. Okay, whatever it was, however you want to measure it, and wherever you want to measure it from, there was a period of consolidation, a brief correction to the 21-day moving average, and then price began to appreciate. Right, and it was a grind up. It wasn't a straight line up. this is how it should work. There should be a series of green candles and sprinkled with some red candles, and price continues to move. And corrections happen along the way. Here's a good illustration of that, right? Bull market happening here, 2016 into the 2017 top around 20K. And look at this. This correction here was, as we said, what, about 30%, a little more than 30%. And then we saw these smaller corrections. This one actually wasn't smaller. It was 35%. And then we saw another one over here that was about 35%. Okay. And this is in a bull market. So don't freak out when we have these corrections. Use them as opportunities. What you need to be careful of is that you don't over leverage yourself. Look at this one. It went almost 40% here. And so those corrections do happen. They're part of the game. It's part of normal trading. I'm not panicked at all that BlackRock did not buy yesterday. Makes no difference in the grand scheme of things to me. Here we are, the 2020 halving, similar set of circumstances. This looks very similar, in fact, to what we're seeing develop right now, perhaps, right? We have some consolidation. We have a retest of support at the 50-week moving average. It held, and then a little bit more consolidation before things already really started to take off. A retest down here at the 21-day moving average. So the moral of the story here is these corrections are normal, and to not be impatient. This one was 15%. Don't be impatient. Don't expect things to shoot up like this all the time, right? It's just not healthy. It's not sustainable. What is sustainable is periods of consolidation, brief corrections, and then areas where price begins to move. All right. So as we get closer to the current time frame, right? Let's take it into our current market situation. Okay, we had an ETF, a lot of anticipation for the ETF. We had a rally from October through the end of the year with this highly anticipated ETF happening in January. We had a period of consolidation in this 40 to 45K range. The sweet spot for that, for me, is around the 44K level, 44, 45K. But look at this, shot up to the 52K level. There was no correction. There was no retest back to this level, back to this range. And same thing happened here. Very brief consolidation at the 50 to 52K level and no retest back to this range. So I say often that straight lines are not sustainable. These are straight lines. And so I would not be the least bit surprised to see a correction eventually develop and bring price back down to this range or this one, right? I play it range by range. So I would look for, my first level, my first invalidation from up here is going to be this 59K level. It has been retested a couple of times, and that's good. That's bullish. That's perhaps an indication that things will hold, and maybe we just range in this, here before we go back out and retest this 2021 high, which has been very difficult to break. We've broken it, but we haven't been able. But it hasn't been sustainable, and that was illustrated here, where I showed you. Well, I thought I was showing you, but that was illustrated here. That we came up to this, rejected again, rejected. Finally broke through, but wicked down. And even though we were making new highs, I saw this weakness, and that was a concern for me. And I expressed that in the very beginning. I want to see full candle bodies with no wicks above this line. And that was not happening. We broke down, we came back, consolidated above it briefly, but we still had wicks coming below, which was a sign of weakness. Adding to those signs of weakness was the volume. Volume was declining. We were up here above this, a prior all-time high, a range that we had been stuck below for literally years, and we're declining, and volume was declining. So this was an indication. If these wicks below weren't an indication to you that this was going to break down, the declining volume should have been your final, the only clue you needed. This wasn't going to hold, and it didn't, right? So we saw a breakdown here. We went back after it again, and wick below, one good candle here, and then the breakdown began. We had some obviously some geopolitical heat in the Middle East here that was a catalyst for this, but catalyst or no catalyst, this is going to happen either way. And so here we are, post-halving. We saw a brief increase in price, and now we're seeing things pull back a little bit. I would not be the least bit concerned about this. what I'm watching here in terms of where price can go is obviously this is the most critical part on the chart for me. The two most critical parts on the chart for me are holding this level here and validating an RS flip, a resistance support flip above this 2021 top at 69K. Not even the new all-time high. Just validate an RS flip above this 69K with no wicks below, and then we can worry about what's up here. To the downside, if we lose this level, if we lose this 59K, I'm looking here, 50 to 52K. And if we lose that, I'm looking here into this area of prior consolidation. To me, this is the strongest foundation for a big leg up. And let's see what that looks like in terms of percentage. A correction here would be from the all-time high, which is up around 73,800-ish. 20% move would take us right here to this lower low at 59K. A 30% move would take us to this 50 to 52K range. And a 40% move would take us to the sweet spot here around 44K. Those are all viable targets in my opinion. Now, here's one key thing to pay attention to, and that is where liquidity is in the order book. And liquidity, in my opinion, equals sentiment. If liquidity is there, there's sentiment to go there. If liquidity is not there, then there's not so much sentiment to go there at this time. This chart's been sitting idle here, so let me refresh it for you. And we'll take a look at liquidity in the order book on fire charts. You can see whales had bought, they sold, bottomed out earlier today, and started buying again. This to me is just trading, right? And it's hard to know in a shorter time frame whether it's accumulation or distribution. If we zoom out, and I'm going to zoom all the way out here for a second to show you, illustrate something that I think is super important here, and that is the dynamic of the liquidity in the order book, meaning the bids versus asks in a higher time frame. So you can see the highest concentration we have is right here around this 60K level, and we have about 52 million stacked there. That's good, but it's not enough. You can see the areas where price has bounced from have had higher concentrations of liquidity. So this bid ladder that goes all the way down to the 50K range is good, right? We want to see that there, but we want to see, and recently in the past few days, we've seen some of what was down here moving up above 60K, and that is also good. In terms, if you're a bull, it's good anyways. What's not good is that we don't have a deep concentration of bid liquidity here. Look at this. This is 96 million and another 93 below it and another 58 below that and so on and so forth. This is over 200 million, 250 million stacked here. Right up here, 134 million, and it sends price down. So we need to see, and there's a history of this, right? If you go through time, you can see this was 127 million. Price moved up. It took not nearly as much to send price down with 60 million up here. Even way out of range. This is just, I don't know, it's weird. These are like signals to the algos or something that send things, cascading down. This one again, 100 million with a nice ladder below it, and price went up. So we're looking for, if bright spots, it's called fire charts for a reason. It's the color of fire, right? The color range of fire, and the brightest spots in this instance represent the higher volume, white being the most, right? So the brightest spot on the chart here is 134 million. We've not seen that heavy of a concentration here yet. It could appear in the next minute, right? They happen just like that, but it obviously hasn't happened yet. So maybe that changes after the Hong Kong buyers come in, but those guys don't want to buy high either, right? They want to buy low. So maybe what we're seeing now is, we can speculate whether this is manipulation or not. It doesn't really matter. All is fair. All seems to be fair in the trading game, right? But when price gets suppressed, then price is coming down into the lower range. What's good to see here, though, is that we have more bids coming into this 60K level. You see it getting brighter and brighter. So So there's two ways this could develop, right? We could see that one big block of liquidity come into either side, bids or asks. If it comes from above, it's going to send price down. If it comes from below, it's going to send price up. Or we could see more liquidity get attracted into the range. So if 60K is the anchor level, then we would see more coming in. And right, this is a good example, right? Uh, Bids have moved up from down here up to this range. So if we start seeing the market kind of front run where the anchor position is and start stacking bid liquidity here, look, asks just came in right above us at 65K, just as I'm sitting here explaining this to you. Right. And this is going to likely send it back down. They want to get filled down here. Okay. When they're pushing this down here, they want to get filled right here. Okay. That's what this exercise is. That's what we're seeing play out right now. And I can take that into the daily and we can see it. Look, if he really wanted to get filled at 65.6, he would have put it. If he really wanted to get filled, they would put it down here, right, at 65. But what he really wants to do, see all this void right here, send price back down through this and get closer to maybe the 61K level or the 60K level. Let me refresh that. Right. So you can see the dynamic in the order book is really where it happens for me, right? We can speculate on the levels that price is going to go up, it's going to go down, it's going to go 10%, 20%, 30%, 40%. This is all highly speculative, right? The targets are not speculative, right? Whether or not it happens is speculative. The targets, we have some history to tell us why we pick these targets, but we don't know if it's actually going to happen or not. But what we can learn from the order book is that wrong screen. What we can learn from the order book is the dynamic, how order book, how the order book and how the order flow is shaping up dynamically to impact price movement. And at this moment, whales had sold, created this dip. Purple whales came in and started buying the dip. And now we wait to see if they're going to continue to buy their way up. Looks like that buying pressure has rolled off a bit, and maybe they're going to succumb to the selling. The thing that whales have to be cautious of is that they have enough liquidity to place those big orders in. CVD here represents market orders. So, right here, while there's liquidity, they could place a decent market order. But down here, where there's nothing or very little, you can't put $1 million order here. You can't put a $900,000 order here because you're going to have slippage. Now, these are market orders. You could put a limit order anywhere you want and not have any slippage. But in terms of market orders and what the CVD represents, they can't go large here or you have issues. So with that, I'm going to wrap it. That was a long, extended analysis today, and I apologize for the beginning of it where I didn't have the charts shared. I hope you guys, I appreciate you guys cluing me in and riding this out with me. And I do appreciate the support you guys have shown me. If you like the content, and I promise the rest of them aren't like this, I try and keep them shorter, and I try and actually show the screens that I'm sharing. Maybe just a little bit discombobulated this morning with a busy morning. Without a doubt. In any case, I appreciate the support you guys are showing me. If you're looking for the description in the YouTube channel, I'm going to place it in there afterwards. I'll type that up, and I'll even put a marker of where this thing should start, so we can get past all the goofiness where I screwed up and didn't show the charts. All right, guys, make it a great day. This week is going by super, super fast. So I hope it is a profitable one for you, and I hope the analysis has given you some insight on what to look for. All right, let's wrap it, and we'll do it again later.